Hello, hello, and welcome everyone from beautiful Switzerland. Today we're diving deep into two terms that you hear thrown around a lot in the finance world: private equity and venture capital. They sound familiar, right? They both deal with private companies, not publicly traded ones, but trust me, by the end of this video, you will be able to tell the two apart like never before. We will look at 8 points where venture capital is different to private equity. Especially the last point made things very clear to me. If you're new here, my name is Johannes and I'm in the process of launching a VC fund myself. On this channel, I take you behind the scenes. As you can tell, I have activated summer mode where I'm not in Dubai, and it's gotten quite hot there the last couple of weeks, so I'm very happy now to have arrived in Europe for the summer. I'll be spending the next couple of months here, mostly in Switzerland. We are full steam ahead with launching this VC fund from scratch, so imagine what it would be like if you could look behind the scenes of such a secretive industry from day one. If you're interested in business, I'm sure you already know the basics of PE and VC, and you can probably name a few companies that do PE like Blackstone or KKR, and VCs like Andreessen Horowitz or Sequoia. But let's cover the basics. What do they do? On the one side, private equity firms invest in mature, established companies. We're talking about businesses that usually have a proven track record, consistent revenues, and are already profitable or very close to it. This is what I used to do in my previous job. Then on the other side, VC is where my current world lives. VC firms invest in brand new early stage companies with high growth potential. Think startups, often pre-revenue, sometimes just an idea on a napkin, but with potential to disrupt an entire industry. So you see the immediate difference. It's maturity. PE is about optimizing and growing what's already working, while VC is about fueling the birth of something entirely new. But let's dig deeper. The second difference is what types of companies they target. Private equity firms typically come in at the growth stage or mature stage of a company's life cycle. These companies might be looking for capital to expand into new markets, acquire competitors, or even just to be taken private from the public market so they can restructure away from quarterly pressures and scrutiny. They're often large, stable businesses. Venture capital, on the other hand, is all about the early stages. I have a different video about the investment strategy of our fund and how we look to categorize companies. In general, VCs look at pre-seed or seed stage companies. This is often the very first external capital a startup receives. Maybe it's just a founder and an idea trying to build a prototype. After that, you have Series A, B, C, etc. As a company grows, it raises subsequent rounds like Series A and Series B, etc., etc. Each round is a sign of progress, and VC firms specialize in these early to mid stages. For my own fund, we're primarily focused on pre-seed and seed stage investments. This means we're often the first institutional money into a company after the friends and family usually. It's incredibly exciting, but also incredibly risky. We're betting on founders, ideas, and market potential, often with very little hard data to go on. That's the thrill and challenge of VC. The check sizes are another massive differentiator. Private equity deals are often massive. We're talking hundreds of millions, even billions of dollars per investment. They usually acquire a controlling stake, meaning they own a majority of the company and have significant influence over its operations and its strategy. At the very least, they will have a seat at the table. They often use a lot of debt. These deals are then called leveraged buyouts. That's how these large transactions are financed. So the fund only puts in a limited amount of money up front, and the rest is debt taken on using the company's cash flows to underwrite it. Venture capital investments are typically much smaller, especially in the early stages. My fund, for example, will be writing checks in the range of a few $100,000 to a few $1 billion for our initial investments. We usually take a minority stake, meaning we own a small percentage of the company. We're not looking to control the company, we're looking to support the founders and help them grow it. We want the founder or the group of founders to be financially incentivized to keep doing what they're doing and keep delivering on the mission. That's how we get alignment, and it's a thrilling process to work with a driven and passionate team. The difference in structure is huge. When PE takes control, they often bring in new management and make big operational changes. In VC, our role is much more supportive. We advise, we connect, we open doors, but the founders are still firmly in the driver's seat. It's It's their vision we're backing. You could see VCs as glorified cheerleaders, if you will. Now let's talk about the elephants in the room, risk and return. Coming from a family business background myself, risk adversity is something I can totally relate to. For many families, this is also what is holding us back in many ways, which is why I've decided to switch gears. Venture capital is inherently high risk, high reward. The vast majority of startups fail. That's the brutal truth. For every success story like Spotify or SpaceX, there's hundreds, if not thousands, of companies out there that never make it. Investors know this going in. We know it. That's why in the portfolio construction model, we account for many of our investments going to zero. Private equity, while still risky, operates a lower risk profile compared to VC. They're investing in more established businesses, so the chance of a complete wipeout is significantly lower. They will have some assets that, if everything goes bad, they could sell. The returns are also generally more consistent, but typically not the astronomical multiples you sometimes see in successful VC exits and exits that we certainly thrive to achieve. This is where the portfolio approach in VC becomes critical. You make a lot of bets, hoping that a few massive winners will offset the losses of the others. It's a power law distribution. One company returning 100x can make up for 10 companies returning 0x. This is a core part of our investment thesis for the new fund. If you own real estate or a forest, for example, which are from a risk-return profile rather boring assets, it could be worth looking at some exposure to a higher risk asset class like venture. Comment below if this portfolio thinking is something that you would be interested in. How do these firms actually make their money back? So-called exit strategy. For venture capital, the primary exit strategies are either an acquisition, so a larger company buys the startup. This is by far the most common. Think Google buying YouTube because it just fits. The other option is to do an IPO. The company goes from a private company to being public, selling shares on a stock exchange. This is the holy grail for many startups and can yield massive returns. It's much rarer. Private equity firms also look for acquisitions, often selling the company to another PE firm, that's secondary transaction, or to a strategic buyer. They might also pursue an IPO, but it's less common than in VC. Their holding periods can also be quite different, 5 to 7 years in PE, whereas VC sometimes holds for even longer just to nurture that growth. This is very much textbook, but exit strategies have come under a lot of pressure in recent years. Acquisitions are often subject to regulatory approval, especially if it's a big transaction. Here, you are at the mercy of political sentiment. The Biden administration, also the EU regulators, have really put the brakes on the M&A market recently. It's expected to come back, at least in the US. So how do these firms add value to the companies they invest in? Because it's not just about the money. Private equity firms are often very hands-on operationally. They focus on improving efficiency and cutting costs, optimizing supply chains, refining the business models, making strategic acquisitions to consolidate market share. They're all about maximizing the existing business. Venture capital firms, they add value in different ways. They offer strategic guidance, connecting founders with mentors, advisors, and experts. They help in talent acquisition, recruiting key hires. They do networking through events or introductions, introducing startups to potential customers, partners, and future investors. They help finding the product market fit to refine product and find the ideal customer. And then for future funding, they guide companies through subsequent fundraising rounds. As a new VC fund, this value creation is a huge part of our pitch to founders. It's not just about the capital, it's about the expertise, the network, and the support we can provide to help the companies navigate the incredibly challenging early stages of building a company. We become true partners. This YouTube channel is actually one of the many ways that we can help company gain exposure. That's why you should subscribe if you want to support founders. Before we move to the most critical difference that helped me draw the line between PE and VC, let's quickly talk about the kinds of people who are attracted to these fields and why they're different. PE professionals often come from investment banking backgrounds with strong financial modeling and M&A experience. VC professionals, on the other hand, often have entrepreneurial backgrounds. They come from consulting or have a strong understanding of technology and specific industries. Now you can see how I fit into the VC world. Beginning of my career, I had much more of a corporate finance background, which is why PE made sense back then. Now, after this entrepreneurial experience, my chapter with the family business, I like the world of VC and what I can contribute. So the last point where PE and VC are different is what made it most obvious to me now that I know it. Private equity is usually about buying out an existing owner of a company. So they take the fund's money and they give it to someone else so they can take control over the assets. Venture, on the other hand, is very different in that sense because the money is put into the company and this capital allows the company to grow and expand. So the money from the fund goes into the company instead of going into someone else's pocket. Therefore, when you invest in a VC fund, you are putting the money in the hands of the founders so they can pursue their mission. In PE, the money goes to previous shareholders. So why am I telling you all this? Because understanding these distinctions is absolutely critical when you're on either side of the table, whether you're building a company or you're building a fund or you're an investor. Launching a VC fund has been an incredibly eye-opening experience. It's almost like a startup, especially in the early days, meeting hundreds of people, founders, investors, service providers. One of the biggest challenges I've faced is the sheer range of jobs. You have to be able to jump around from building your investment thesis to talking to all sorts of founders, and it feels like everyone on LinkedIn and IRL is trying to sell you. When you're brainstorming with limited partners, the people who invest in your fund, we are not marketing yet. So these are just hypothetical discussions, just to be clear. You have to clearly articulate your strategy, your unique edge, and how you plan to generate those returns in the VC space. It's a completely different sales pitch than raising capital for an operating business. I'm building a fund that will specifically look for deep tech, medtech, and life sciences opportunities. People often tell me it's a difficult time right now. While that may be the case, when has something like this ever been easy? I'm passionate about building a community-driven investment firm, so it's amazing to me that over 90% of you are not subscribed. Now is your moment to change that, and if you're interested how this journey started, watch this video next.